In the fast-paced and often unpredictable world of cryptocurrency, certain signals can send ripples of concern or excitement through the market. One such signal, known as the death cross, has just appeared on the charts for Shiba Inu, or SHIB, and it's capturing the attention of traders and investors everywhere. The death cross is a technical pattern that occurs when a short-term moving average crosses below a long-term moving average. While it isn't a guarantee of disaster, it's widely regarded as a statistical warning sign that shouldn't be ignored. This pattern suggests that the recent positive momentum SHIB enjoyed may be losing steam, and that the bullish energy driving prices higher could be fading away. Here at Crypto Insider, we believe in focusing on hard data and thorough analysis, not just the hype or fear that often dominates crypto discussions. The emergence of a death cross could be a pivotal event, potentially shaping SHIB's price action for the weeks and even months ahead. It marks a moment where the market's direction is called into question. For anyone involved in the crypto space, whether you're a seasoned trader or a curious newcomer, understanding what this signal means is absolutely essential. Not long ago, SHIB experienced a surge in value, with impressive gains that reignited hope and enthusiasm within its passionate community. Many believed a new rally was just beginning. However, the appearance of the death cross now introduces a strong note of caution, serving as a counterbalance to the recent wave of optimism. It's a reminder that markets can shift quickly, and that euphoria can sometimes give way to uncertainty. Technical analysis, like the death cross, provides an objective lens through which to view market sentiment, cutting through emotional reactions and focusing on patterns in the data. The current chart setup suggests a potential shift in power from buyers to sellers, indicating that bearish forces may be gaining the upper hand. Ignoring such a clear technical signal would be unwise, especially in a market as volatile as crypto, where fortunes can change overnight. This isn't just financial jargon or a theoretical concept. The death cross can have real-world implications for SHIB holders, affecting both short-term decisions and long-term strategies. It prompts investors to reevaluate their positions, consider the risks they're taking, and perhaps adjust their portfolios in response to changing market conditions. The big question now is whether the market is simply taking a breather after a strong run, or if this is the beginning of a more significant downturn for SHIB. The death cross pattern provides a valuable framework for asking these questions and for making informed decisions in uncertain times. By closely examining the data and understanding the context behind these signals, we can build a much clearer and more accurate picture of SHIB's current situation and its possible future. The death cross is more than just a headline. It's a crucial development for anyone invested in SHIB, and understanding its full story could make all the difference in your next move. What exactly is this so-called death cross, and why do traders pay so much attention to it? The death cross is a visual signal used in technical analysis, and it often sparks a lot of discussion among investors and traders. It occurs when a short-term moving average, which tracks recent price action, crosses below a long-term moving average, which smooths out price data over a much longer period. For SHIB and many other assets, the most commonly used moving averages are the 50-day and the 200-day simple moving averages, or SMAs for short. The 50-day SMA gives us a snapshot of recent price trends, reflecting how the asset has performed over the last couple of months. In contrast, the 200-day SMA represents the broader, long-term trend, smoothing out short-term volatility to show the bigger picture. The death cross specifically happens when the 50-day SMA falls below the 200-day SMA, signaling that recent price momentum has turned negative compared to the longer-term trend. This suggests that recent negative momentum is overpowering the long-term positive trend, and it can be a warning sign that the market's mood is shifting. To make it easier to understand, imagine you're tracking a restaurant's popularity. The 50-day SMA is like the average number of customers over the past 50 days, while the 200-day SMA is the average over the past 200 days. If the recent average drops below the long-term average, it could mean the restaurant is losing its appeal. In the same way, a drop in the 50-day SMA below the 200-day SMA on a price chart signals a significant shift in sentiment and often triggers alerts for traders and analysts. The death cross is widely seen as a bearish signal, reflecting a change in market dynamics that could lead to further declines. It indicates that bullish momentum is fading and that selling pressure is starting to dominate. which can make investors more cautious. For traders, the death cross acts as a caution flag, suggesting that the price path may now be downward, and that it might be time to reconsider bullish positions or tighten risk controls. It's important to remember, though, that the death cross is a lagging indicator. It confirms a trend that has already started, rather than predicting one before it happens. Still, its clarity and simplicity make it a powerful tool for confirming major shifts in market direction. A death cross doesn't exist in a vacuum. Trading volume is crucial. When analyzing technical signals like the death cross, it's important to look beyond just the price action. Volume acts as a magnifying glass, revealing the true strength or weakness behind every move. Volume is the fuel driving market trends. It shows us whether traders are truly committed to a direction, or if price changes are happening on shaky ground. High volume during price changes indicates strong conviction. When you see a surge in volume alongside a big move, it means many participants are actively buying or selling, lending credibility to the trend. But what if a death cross occurs with declining volume, as with SHIB? This scenario tells a different story, one where the market's energy is fading, and fewer traders are willing to take decisive action. This suggests market apathy or uncertainty. Traders may be hesitant, unsure whether to commit to a new trend or wait for clearer signals. Low volume can make signals less reliable but offers unique insights. It often means that the market is lacking conviction, and any price movement could be easily reversed if sentiment shifts. The declining volume with the death cross suggests weak seller conviction. Sellers aren't pushing hard, so the downward move may not have much momentum behind it. It's a warning of weakness, not collapse. The market is signaling caution, not panic. And this distinction is vital for traders making decisions. The market is in limbo, waiting for a catalyst. Without strong volume, neither buyers nor sellers are in control, and the next big move could go either way. SHIB's recent gains on low volume hinted at unsustainable rallies. When prices rise without strong participation, it often means the move is fragile and could quickly reverse. The death cross confirms underlying weakness. It's a technical signal that, when paired with low volume, highlights a lack of confidence in the current trend. Traders are on the sidelines, waiting for a clear direction. Until volume returns and conviction builds, the market remains in a state of uncertainty, watching for the next decisive move. The 600-unit mark is SHIB's critical support level. This price level has been a significant psychological and technical floor. When the price nears this level, it's a test of market resolve. Support levels are created by concentrated demand. The 600-unit level has been a strong foundation for SHIBA. The death cross above this support creates a high-stakes scenario. If SHIB reaches this level, market reaction will be telling. A bounce with increased buying volume suggests strong support. Alternatively, breaking below with selling volume is bearish. This could lead to a deeper price correction. All eyes are on this threshold. Its defense or failure will dictate SHIB's trajectory. Echoes of the past. Lessons from August 2023. History doesn't repeat exactly but often rhymes. In August 2023, SHIB experienced a death cross followed by a downturn. This serves as a cautionary tale for today's market. The death cross confirmed a deteriorating market structure. Following the cross, SHIB struggled to find support. This historical example shows a death cross can signal sustained bearish pressure. However, differences between then and now matter. A strong fundamental catalyst can override a bearish signal. The key lesson is risk management. The current signal should be seen as a warning. Two roads diverge. Potential scenarios for SHIB's future. With the death cross confirmed, SHIB stands at a fork. The bearish scenario is suggested by the death cross. Low buying interest and volume could lead to a slow price drift. The real test is at the 600-unit support. A breakdown, with confirmation signals bearish control. Alternatively, a bullish scenario could occur. A surge in buying volume at support could trigger a bounce. A strong rebound could invalidate the death cross. The outcome will define SHIB's trend for the year. The battle between bearish signals and support is crucial. Navigating uncertainty. The prudent path forward. The death cross is a warning, not a verdict. It signals shifted market dynamics and increased downturn risks. The prudent path is careful observation and informed decision-making. Accurate, timely information, and a clear head are vital. Focus on key indicators, trading volume and price action at support. React to market actions, not hopes. This highlights the importance of a clear strategy. Long-term holders should reevaluate SHIB's fundamentals. Short-term traders should manage risk diligently. By respecting signals and staying informed, navigate uncertainty confidently.